From Bloomberg headquarters in New York, this is Market Makers with Eric Schatzker and Stephanie Ruhle.
I'm Eric Schatzker, and this is Market Makers. When will the Fed quit QE, and what happens when it does? Those questions are the obsession of financial markets, and they have enormous implications for the economy at large. Who better to ask than the king of the bond market himself? He's PIMCO's co-founder and co-chief investment officer, Bill Gross. He oversees more than $2 trillion and runs the world's biggest mutual fund. With us from Newport Beach, California. Once again on Market Makers, Bill, it's always great to see you, and thank you for joining us. Good morning to you, and let me begin by asking the question: do you believe any of the, or do you
order
buy,
filled?
Do you take stock, Bill, in any of the speculation that the Fed is seriously considering a so-called taper, the buzzword of the moment, of its quantitative easing program as early as the third quarter?
I think, Eric, that some of them do, and the question becomes who are the important ones and who controls the vote, so to speak. I think the chairman believes, for instance, that it's necessary to avoid the Fed's admitted mistake of premature tightening in the 1930s and the perceived flaws of the Bank of Japan during the lost several decades. We at PIMCO have no quarrels with that. What does concern us, and I think it concerns others like Richard Fisher at Dallas and others, other presidents. What concerns us is that there are increasing negatives for these zero-based money and quantitative easing policies, and it's simply our view that the longer they continue to move, that they continue to distort capital markets and lead to misallocation of capital. And so that's why some of them, at least, are considering a reduction of purchases and a tapering.
What is your view on treasuries right now, Bill? Because last time you were here, you showed us on the smile that we are at the end of the 30-year bull market for bonds, yet we know that you've also been in the mode where you say the economy's not doing great and you need to preserve capital and hold treasuries.
Yes, I think that's been proven in the last month or so. Certainly, the bond bull market abruptly ended probably around April 29th, I guess, to be exact, and that was the exact date I suppose that I tweeted. But treasuries in the last few weeks have certainly been the place to be. I mean, we've seen unwindings of leverage on a global basis, perhaps because of the Bank of Japan. We can talk about that in a second. But, at the moment, markets are in disarray, not just equity markets, but high-yield markets, risk markets, currency markets, emerging markets. The bid-ask spreads in these markets is wide, to say the least. The liquidity is low, to say the least. And, to be able to exit these markets today or yesterday or last week has been very difficult. So it's been good for PIMCO to have been high-quality oriented and to have recognized the risk in terms of low yields and low future returns.
Bill, do the observations that you just made about financial markets say something about central banks? For the past several years, fighting central banks has been a losing trade. In fact, anybody who tried it got his clock cleaned. Has something happened? Have we passed an inflection point where perhaps now the investor or investors as a group can challenge central banks, can trade against, say, quantitative easing and perhaps win?
We continue to say you never want to fight the central banks. They're the ones with the check writing power, with trillions of dollars worth of purchasing, or in the case of tapering, less purchasing power, I suppose. What we think has happened, Eric, in the past month or so is that the Bank of Japan has set in motion, perhaps an unanticipated increase in currency, interest rate, and spread volatility. They didn't want to do this, but, we suppose that they expected their QE to act much like the Fed's QE, and that was, dampening volatility and keeping interest rates low. That hasn't happened, perhaps because, clearly their policy was directed at yen weakness, and as long as that weakness was gradual and yields stayed low, then the levered community, levered speculators, hedge fund managers, et cetera, could bank on a cheap and attractive form of currency funding on the short side. When the volatility and rates went higher as opposed to lower, as they did in the experience experienced in the United States, then levered speculators were forced to reduce positions, and that's the story of the past few weeks. It's not that the vigilantes now have control. It's that, levered positions are running for the exits.
I want to ask you about TIPS, Treasury Inflation Protected Securities. We know that you've been a fan of those. You've been tweeting about them lately. Not much in the way of inflation. Are you still buying TIPS, and what's the thinking here?
Well, we're holding TIPS. It appears in these delevering moments that anything but a pure Treasury, a nominal Treasury, is at risk in terms of liquidation. And it's true, Stephanie, that as economic growth weakens and as markets weaken, stocks come down, that the anticipation would be that inflation continues to be contained, if that's the appropriate word that Fed officials would use, and I suppose they would use it. And so, TIPS are not the most attractive Treasury in that type of environment. We still feel over a longer-term basis, and that's why we own TIPS, for the next 3 to 5 years, our secular outlook that the result of all of this spending power, the $75 billion a month from the BOJ, the $85 billion from the Fed, admittedly with a possibility of tapering, but all of this in combination, the trillions of dollars of check writing, ultimately will produce, not inflation in the 1970s mode, but something resembling at least a 2 to 3% level, which gives, some attraction for inflation insurance on the TIP side.
All right, Bill Gross, we're going to continue the conversation with you. Definitely want to get to Japan and the monetary experiment going on there with Abenomics and the rest. Bill Gross of PIMCO will be joining us again on the other side of the break on Market Makers on Bloomberg Television. This is Market Makers. I'm Sarah Eisen. We are back with Bill Gross of PIMCO. The world, Bill, is watching the great experiment of Abenomics to wake up the Japanese economy. Yes, stocks are up and the yen is significantly weaker, but in the last few weeks or so, we have seen enormous volatility. Stocks down 17% since the highs. What do you make of all that, and do you buy into the idea that this may not work?
Well, we do buy into the possibility, and I apologize for calling you Stephanie. I wake up to you, Sarah, every morning at 7:30 Eastern. You're my first cup of coffee. So
love to hear that.
In any case, yeah, what do we make of it? Well, let me tell you what we would have initially made of it. You know, when the BOJ buys $75 billion a month, then somebody has to sell it. And our original assumption would be that you know, internal insurance companies and banks within Japan would sell JGBs and then start to look for alternatives in terms of treasury space or emerging space or some higher yielding space. You know, certainly it appears that they haven't done that. Perhaps they've simply reduced their durations, raised cash. You know, it doesn't appear that much has come outside the country. Perhaps in retail space, what we call Mrs. Watanabe and her preferences, perhaps some of that has leaked out, but I would think in the last few weeks, based upon the inherent volatility of risk markets, that you know, they're just staying put. So it is a conundrum, not to use the well-phrased word, I guess, you know, going forward, but it's a conundrum to know where this money goes, because the BOJ is perhaps buying as much as the Treasury is issuing, and it's a fair question to know where the money flows to. We don't know at the moment. We're trying to monitor it closely. What we do know, as I mentioned earlier, is that the yen volatility and the volatility in the JGB market on a nightly basis basically has upset, you know, levered holders of not just risk assets but treasury assets, because there are levered holders of treasury assets, and so when the volatility increases and the uncertainty in terms of the yen and the position, you know, going forward of